Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets and what happened this last week, while also drowning out the agenda of the news media in America. So let's talk about the 4 things that we learned in the markets this week. Point number 1, Tuesday. This week, the consumer price index numbers were released on Tuesday, and it wasn't good. Inflation gradually increased, providing directionally the wrong path for the inflation trend. The market fell apart on Tuesday and couldn't recover for the remainder of the week. Stocks even fell today, Friday, to wrap up one of the worst weeks in months. And FedEx today was the star of the show. It was the belle of the ball with pretty bad earnings. They were, in a bad way, the belle of the ball. FedEx shares plunged 21.4% today. Imagine having that in your 401k. It's why you don't have single stocks, in our opinion. And their CEO predicted a worldwide recession soon. For the week, the Dow Jones Industrial declined 4.1%. The S&P 500 lost 4.8%. And the NASDAQ dropped 5.5%. Point number 2. Last week I spoke about the Atlanta Fed's GDP Now model, which has been a very accurate predictor of where the GDP, which is the gross domestic product, the growth of our economy, where it'll land for the current quarter we're in. Last week they were predicting 2.6% growth for the third quarter, and this week that number plunged to 0.5%, positive still, but 0.5%. Yesterday's report on retail sales, industrial production, and the import-export prices pushed this model, the Atlanta GDP's model, to cut its estimate. This shows that after a pickup in economic activity in July, things have started to slow down in August. Point number 3. One reason we most likely have not retested the June 2022 lows in the market is that markets still believe that any recession caused by the Federal Reserve monetary policy will be mild and that corporate profits will remain resilient. The upcoming quarter 3 earnings season, which will kick off in October, is going to be critical to either supporting this thesis or challenging it. Something we'll be watching very, very closely, third quarter earnings in October. Point number 4, the S&P 500 is down close to 20% for the year. Did you know that the S&P 500 has posted a negative return in only 13 of the last 64 years? Wow! That means a lot more ups than downs, and it means when you get a down like this year, even though it feels like the world is ending, I promise you it is not. And it provides an excellent buying opportunity for those that think like Buffett. Buy low, sell high. Don't do the opposite. Here are some stats on those 13 negative years over the last 64. 11 of the 13 negative years saw a first quarter, January through March, that was negative. We were negative this first quarter, down about 4.9%. 9 of the 13 years then had a negative second quarter, April through June. This year we were negative 16.4%. 77% of the time, the third quarter was negative in years where the market ended negative. And of course, we're still in our third quarter and we're barely positive. Finally, what happened historically in the fourth quarter, maybe an indicator of what's going to happen? Well, good news here, it's your best odds in a negative year. Less than half, only about 46%, saw a fourth quarter negative. And maybe more encouraging, when it was negative, it was typically only down about 0.01. One thing I know, I did take out the 2008 numbers because it's such an outlier to everything else. So those were the 4 things we learned in the markets this last week. Hopefully that was helpful to you. As always, if you have any questions about what's going on in the market and how it's affecting your personal situation, please reach out to one of our advisors through the link in the notes to schedule a meeting, as well as you can check out our blog. The link is also in the notes there for that, where you can read any of the articles we wrote. And lastly, but maybe most importantly, your stress level could be an indicator of your view of money. One of the things that always helps me is thinking through the baseline that I have to keep my life around, that God owns it all. If he owns it all, and I believe that, then when we go through these bad weeks in the market, nay, bad years like this, my stress level doesn't increase because it's God's asset, and I believe he's sovereign over all that. So hopefully that was helpful to you. We look forward to talking to you next week. Certainly feel free to reach out to us.